There's a lot of big numbers coming out now that silver's turned again. We were one of the first to say 300, not by the end of this summer, however, and we do see 4 digits and we do see single digits gold-silver ratio eventually. But that's a topic for the dollar loss in value. So stay grounded. There will be opportunities. Don't get too mega hyped because we've had a decent turn. It's not a runaway. You're not straight back to full ball runaway bull. You've stopped going down and you put in a reasonable bottom, and there's a little bit of buoyancy generally to the prices. Don't lose your head about what you expect before this year because of call strategies that have seen, out of the money calls being bought and other things.
Recent market movements indicate that precious metals have established a firm floor after a prolonged period of consolidation. Investors watching these technical shifts must navigate between short-term volatility and long-term monetary fundamentals without falling prey to ungrounded hype. FrancisHunt, a seasoned trader and market strategist, emphasizes that while precious metals have found a localized bottom, their ultimate multi-year trajectory remains tied to the severe devaluation of fiat currencies. He predicts silver will eventually reach $300 and push into 4-digit territory, driving the gold-to-silver ratio down into single digits for the remainder of the year. He forecasts a 60% probability that prices will trade within a consolidated range between localized lows and previous highs rather than executing an immediate runaway breakout. Furthermore, he leaves a 15% to 20% tail risk possibility for a temporary debt-driven market flush, which would present a historic buying opportunity before a broader monetary reset takes hold. Now, we present the clips from FrancisHunt's interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
We went into the end of Jan very strong. We had a little bit of a warning with a blow-off volatility to 5.6, but pretty much you were trending all the way along here from our end of August, September break, which is the same time now. So it's kind of ironic, just a little seasonality point to plant as a seed here. Tail end of August, here we were, and we call for that breakout. So we were once, twice, 3 times a lady at 2K, saying it was going to 3K at around the 3K level. Again, August, going and break, run all the way up, 5.6, the absolute high. Trended into this point, then we sold off. That was first impulse. Second impulse was a long, bloated one, a bit of a heartache for precious metals fans, especially the silver guys. Lots of selling coming off. Of course, Hormuz, the oil started to take precedence over precious metals. A lot of surplus nations were rolling their excesses of net imports by America into gold. So the deficits that the US was running was leaning to the gold run. So hence the war actually got those surplus trade nations focusing on their energies. All of them are energy importers. So they then had to focus on oil and depth of inventory on energies. And that ended up being a long, bloated second impulse into the lows. But what you can see technically, a little bit of a buying up wick on that hammer. It started again, another hammer, and then another hammer over here. We thought we would be up and running. And then there was a little wobble, and then we kind of got frozen in just up north side of the 4K level, and a week before last, we were saying we think midweek, the following week, we'll be breaking out. We had a beautiful little, on a much smaller time frame now, there's that 4,000 mark. You had the upside HVF structure, which is what we focus on. It's very light, very, very good breakout pattern. I can't recommend it enough. And of course here, instead of just trading the pattern to the target that was suggesting a 4,300, we were aware that the small pattern is breaking us out of the larger pattern, the falling wedge. And the first in a new trend always has overperformance. So we stay long. You might just about make out that there's a channel in here. We call this an overperformance trumpet, and it particularly applies on first setups in new trends. So you keep long technically until such time as you either fall out the lower part of the trumpet channel, Or if you break out the top, we wait until you return and cross back in. So we close there. So if you're going to hyperperform and break out, we only close on the return into the channel. So that's the methodology, a little bit of what we do in terms of trading the gold market. It's been absolutely fabulous for us. And I just, for authenticity's sake, we really do play in the markets. These are entries here on one platform that we've carried over. I have closed those now. They were all around 4043, 51 and 53, different platforms as well. We trade this all the way across, and it's been a very, very profitable entry for us, as you can see, across different platforms. So I'm hoping those that do a little bit of trading, I hope you know what you do, first of all, non-advisory, have also enjoyed it. But for the rest of us that are just also blue pot investors, and, we didn't sell silver or gold throughout this coming down. In terms of unleveraged, we don't sell, we're net accumulators, because the big game hasn't yet happened, the grand reset of debt and fiat, although I think you might be taking us into those weeds when we talk about recent events with Besant and the JPY. But yeah, that's, I suppose, my opening salvo on, a very pleasant and a profitable period for us. You would say 54 probably on silver was your localized low, and those 39 54s on gold were a localized low for us. There's just one. There's some people that have gone completely, I hesitate to say, a little bit too crypto for me in terms of predictions and timings on precious metals. I want to warn that there's a real debt-based potential crisis. I think you might want to talk more about that, so I'll not say too much on that. But that's a wild card that can see everything get sold in margin by the same institutions that are currently metals buyers, by the way. And most of this precious metals move as central banks and institutions. It's not excessive retail participation. That was happening here near the highs. Sadly, retail are like dogs that chase cars. They really want momentum. They don't know what to do if the car's stationary. We're not. The retail engagement here is far lower, I would imagine, than the retail engagement was over there as a percentage. And even still, the price makers are the institutions and the central banks and the nation states, I suppose. China would be probably qualify as a price maker and chaser at the moment. What we're actually saying is we feel that's a localized bottom. We leave a door open for an exceptional event that could lead to, and it's the kind that would be a headline event. Subprime, the spill from $1,003 down to $698. CV19, you had silver fall to, I think it was 11 or 14. I can't quite remember at the absolute low. Technically, I don't think you could buy it at that level. You might get that. But outside of that, let's say 10%, 15% possibility, we feel this is a localized low. But we also, following on from that, we don't want to just go, you're just going to go ripping. This doesn't have unbelievable volume, and there has been some pushback at the end in both wicks so far. You can tell by the weightiness, the degree of volume. This is a good working off a low move to put you into mid-range. It's not escape velocity for new highs by before Christmas, I don't feel. I think we're going to finish in the larger range between the previous high, 121, and, the low of 55. I would say that's your 60% probability. The chance you go beyond, maybe 25% on the high side, and maybe 15% on the downside for the remainder of the year. So for people that are just asking where we're going to be come Christmas or mid-December, the markets usually slow down a little bit. They can sometimes move a touch. I would say in range, which is the previous high and this as localized low. I would give you my 60% number in there, Elijah, in terms of silver, which can be quite good. You can be at 82, you could be at 77. I think it's generally going to drift and be more buoyant than heavy, outside of that wild card regarding debt and a major demand-destroying event, which is building, it has to be said.
The global financial architecture continues to operate on an unsustainable foundation of debt creation and massive central bank interventions. Trillions of dollars in emergency liquidity injections have severely diluted fiat currencies worldwide, benefiting major transnational banking entities at the expense of average working-class wages. Over $23 trillion in emergency loans were previously funneled to top international banks, proving that these corporate institutions routinely privatize their upside gains while socializing their downside losses through public currency debasement. This ongoing devaluation creates an artificial two-tier economic structure that accelerates wealth polarization. To effectively counter this systemic erosion, individuals must prioritize financial self-reliance, reduce reliance on fragile centralized institutions, foster resilient community networks, and secure tangible physical assets that stand completely outside the debt-driven banking apparatus. Now, let's get back to the interview.
Huge bank bailout, 23 trillion in loans were sent to all of the big bulge banks, including non-US banks, by the Federal Reserve, which is technically a US central bank. UBS, Credit Suisse, Barclays were bailed out. Americans should be angry about that, your dollar being diluted for foreign banks. But that's why I say you have to see it as a transnational network rather than nation-stated. Too many people see country verticals and silos. There's a transnational network working here. Of course, JP Morgan got about 4.3 trillion. And then there was the subprime where the bailouts happened there. Those almost look small by today's standards. Inflation sure is a thing. Trillions today, hundreds of billions last crisis before that. But they've continued to privatize their gains and socialize their losses, which is an immoral system. And it keeps people who go, oh, the equality, the Gini curve. Yes, we've got so much work to do there and all of that. And yet you allow them to make unbelievable millions on the upside, and whenever they get it wrong, you dilute the money for all the people on working wages that are not increasing at the same rate that you're devaluing the money. So, those are crocodile tears of pure theater that they have about the inequality. That's mood music. They don't care. In fact, the two-tier society is one of intent, a supremacist class and serfdom. I'm almost sure of that. So the polarization is well on its way. And to fight that, we truly need to be off-grid as much as possible, self-reliant as much as possible, and holding as much metal as much as possible, and saving our community members and neighbors so that we can have safe little localized pockets of self-sustainability and support in an environment where the bigger structures are going to be redrawn entirely. This crisis and crash, when it comes, the mathematical scale of it is so vast, Elijah, it's going to make economic history for centuries. You haven't seen the scale of it. And it's the whole Western Hemisphere. As I say, it's not me just beating up on where the American debt situation is. It's not about the beautiful American people I know and love. It's about an entire transnational westernized system that is going to be taken down. Russia had its Bolshevik revolution, China had its communist revolution, and I fear for us it's going to get very totalitarian and very hollowed out in the West. It's our number that is up. And we're in injury time. Since 2020 and the turn of that debt markets, we're in injury time for that crash, which is why when I bring you back to the forecasts on silver and gold, I say for now up and probably into the range, but I leave that wild card door that there's a 10 and 15%, and it could even be 20%. We could trade lower when they sell everything that isn't nailed down in such an event, and I expect us to end, let's say, Christmas Day in between the highs of 121 on silver and 5,600 on gold and the 4,000 low, probably 55-60%, but I leave a 20% on either side for the demand-destroying event, possibility on the downside, and a massive opportunity if you happen to have cash and you've not lost your job and you're not one of those that are reeling in any crash, and the extreme possibility that, we could shoot beyond the high in the remaining 5-6 months. But I think we're going to be in range for both gold and silver moderately and generally drifting up, but a bit down, and a bit subjected to news flow until the big baked Ponzi unwinds. And then there will probably be a final washout. Technically, before major moves in precious metals, there is a downside washout. I mentioned 1,003 down to 698. That was, earlier in my gold trading days. That was 2008. I mentioned you then ran to 1927, all the way up from that 698. But a lot of people were very bearish, and a lot of a flush out happened at subprime. People were morbid. The only way is whatever demand, no matter how horrible it is, and whatever war or whatever theme or whatever drama it has that crashes precious metals, when it crashes, you buy. And it's harder to do because the news is going to be tough. And the same happened in CV19. Half of us didn't know it'd still be around in 10 years. There was so much successful fear as product marketed and pushed towards us. That's why we streamed every day to keep people's moods up. We could see that was suppressing immune systems and psychology. It was a real mental psyop, and people, would be suicidal and trapped. We really took that really seriously as a community project to everybody. And the gold price fell. We can have a look at the chart, how much, I can't recall, but it fell quite substantially. And silver, of course, made the $11. Although, as I say, you probably could only buy it about 13 or 14 at best. But then afterwards, we went to 2000s plus on gold, and silver shot right back up to the 35s and 40s before settling down in the 25, 26. And the last move that we've made since our once, twice, three times a lady, we also got a little bit of friction and a little bit of build-up on that big broadening structure. We went 3 years sideways with 3 hits of selling. For 3 years from 2021, we went sideways. It really ran people down. They started to give up on it, and there were some big sell-offs in there, and it came back. Big megaphone, but then when it went 2,000, 5,600 next. Pretty quick in literally a year and a bit. So I'm warning everybody there'll be a flush out, and that could take out what I think is a localized low. It could, on that 20% probability. So be prepared for that, and it's the best buying opportunity you're ever going to get. Keep dollar cost averaging. If that happens, go. So I'm letting this drift up. We're glad to have taken great trades out of it. I just net accumulate on the blue pot unleveraged side. And that's what's going to be the saving grace for us all.
Navigating modern financial markets requires recognizing the fundamental divide between emotional retail traders and institutional price makers. Retail participants frequently chase price momentum near market highs, often struggling to act when asset prices remain stationary or consolidated at lower levels. In contrast, central banks, sovereign nations, and major financial institutions systematically accumulate assets during periods of quiet market building. Technical chart patterns reveal that major multi-year bull runs in precious metals are almost always preceded by severe downside liquidations. Historical sell-offs, such as the sharp liquidations witnessed during the 2008 subprime crisis and the 2020 global shock, demonstrated how widespread fear causes panic selling across all asset classes as institutions face urgent liquidity demands. During these extreme liquidity squeezes, prices temporarily break down below baseline support levels despite strong long-term fundamentals. Maintaining discipline during such market washouts is challenging due to overwhelming negative media narratives and economic uncertainty. However, disciplined investors who focus on unleveraged accumulation and dollar-cost averaging can successfully navigate these periods of psychological stress. Securing physical holdings and maintaining personal resilience remain key strategies for enduring major structural shifts in the global economy. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.